Welcome to Money Minds. Have you ever wondered why financial literacy is so important in today's Here's a Picture for You? You're navigating a vast ocean, the economic landscape of our time, in a ship called financial literacy. To sail smoothly, you need a compass, a map, and a clear understanding of your destination. That's what financial literacy equips you with, the knowledge and skills to make informed, effective decisions about your money. But what does being financially literate entail? It's not just about knowing how to count your coins or read a bank statement, it's a journey of understanding 4 cardinal rules: mastering basic financial concepts, embracing risk management, controlling debt, and planning the future. Mastering basic financial concepts is like learning the language of money. It's about understanding budgeting, interest rates, and the time value of money. Embracing risk management is about assessing the risk-reward trade-offs in financial decisions. Controlling debt means understanding terms, interest rates, and repayment schedules. As for planning for the future, it's about investment and retirement planning. These rules lay the foundation for enduring prosperity and security in your financial endeavors. So, buckle up, and let's dive deeper into each of these rules and understand why they are so integral to financial literacy. Firstly, we have the rule of mastering basic financial concepts. Picture this: you're standing in front of a towering structure. This is your financial future. But how stable is this structure? Its foundation, its backbone, is built on basic financial concepts: budgeting, interest rates, and the time value of money. These are the bricks and mortar of your financial world. Let's start with budgeting. It's more than just tracking your income and expenses. It's about understanding your financial limitations, knowing how to allocate resources wisely, and adjusting your spending habits to meet your financial goals. It's the tool that allows you to take control of your money, rather than letting it control you. Next, we delve into the realm of interest rates. These rates are the cost of borrowing money and the reward for saving it. Understanding how interest rates work is crucial for making informed decisions about loans, savings, and investments. When interest rates are high, borrowing becomes more expensive, but your savings and investments yield more. Conversely, when rates are low, borrowing is cheaper, but your savings and investments grow less. This understanding helps you make the most of your money. Lastly, we tackle the time value of money, a concept that asserts money available now is worth more than the same amount in the future. This is due to its potential earning capacity. If you have $100 today, you could invest it and earn interest, making it worth more than $100 in the future. This concept is pivotal in making investment decisions and retirement planning. In the intricate maze of the financial world, these basic financial concepts are your compass. They form the foundation of your financial knowledge, guide your decisions, and help you avoid costly mistakes. They are the first step to financial literacy, the bridge that connects you to financial independence and security. With a solid grasp of these concepts, you are better equipped to navigate the financial world. Moving on to the second rule, we have embracing risk management. Now, when we talk about risk management in finance, it's not about becoming risk-averse. Quite the contrary, it's about understanding and navigating the risks involved in financial decisions. Think of it this way: life itself is a series of risk-reward trade-offs. Each decision you make carries some level of risk and potential reward. In finance, this concept becomes even more crucial, as the stakes are often high. Risk management, therefore, involves assessing these risk-reward trade-offs. It's about weighing the potential losses against the potential gains before making a financial decision. This could be as simple as deciding whether to save or spend your money, or as complex as choosing the right investment portfolio. You see, every investment carries a certain level of risk. The higher the risk, usually, the higher the potential return. But high return also means a higher chance of loss. That's where risk management comes in. It helps you strike a balance between risk and reward, enabling you to make informed decisions that align with your financial goals and risk tolerance. For instance, let's say you are considering investing in the stock market. Without risk management, you might be tempted to invest heavily in high-risk stocks with the hope of high returns. But with proper risk management, you would assess the potential losses against the gains, diversify your portfolio to spread the risk, and decide on a more balanced approach. Risk management also involves being prepared for unexpected events that could impact your financial situation. This could mean setting aside an emergency fund, getting the right insurance coverage, or having a contingency plan in place. In essence, embracing risk management is about embracing the uncertainties of the financial world and turning them into calculated decisions. It's about making sure that no matter what happens, you are not caught off guard and your financial health remains intact. Remember, risk management is not about avoiding risk, but about making calculated decisions. The third rule of financial literacy is controlling debt. Now, when we hear the word debt, it often carries a negative connotation. But let's clarify something. Debt is not inherently bad. It's uncontrolled debt that can lead to financial turmoil. Understanding the terms, interest rates, and repayment schedules associated with your debt is crucial in controlling it. Let's break this down. Terms are the conditions or agreements you make with your lender, including the amount borrowed and the repayment timeline. It's essential to thoroughly understand these terms before signing any agreement. Interest rates are the cost of borrowing money expressed as a percentage of the loan. They can be fixed, remaining constant over the life of the loan, or variable, changing in relation to market conditions. Understanding interest rates helps you calculate the total cost of your debt and strategize on repayment. Repayment schedules outline when and how often payments should be made. Regularly following your repayment schedule can prevent late fees and negative impacts on your credit score. It also provides a clear path to becoming debt-free. Effectively controlling debt can lead to financial stability. It's about making informed decisions on how much debt you can afford, prioritizing repayments, and ensuring you're not living beyond your means. It's about using debt as a tool, not letting it use you. And remember, controlling debt is not about avoiding it altogether. Debt can be a powerful tool when used correctly, providing opportunities for homeownership, higher education, or starting a business. The key is to manage it effectively. It's about being proactive, not reactive. It's about understanding your obligations and meeting them head-on. Controlling debt is not about avoiding it altogether, but about managing it effectively. Lastly, we have the rule of planning for the future. It's like painting a picture of what you want your financial life to look like, and then creating a path to get there. Foresight is the key, and two crucial elements of future planning are investment and retirement planning. Let's start with investment planning. It's about making your money work for you. You see, money is a resource, and just like any other resource, it can be used to create more. That's what investment is all about. Whether it's stocks, bonds, mutual funds, or real estate, the goal is the same: to grow your wealth over time. But remember, investing isn't a get-rich-quick scheme. It's a long-term strategy that requires patience and discipline. Now, on to retirement planning. Many people tend to overlook this aspect of financial planning, but it's just as important. Retirement planning isn't just about saving money. It's about building a nest egg that will sustain you when you're no longer working. It's about ensuring that you'll have enough to cover your living expenses, healthcare, and any other costs that come with aging. And here's the thing about retirement planning: the sooner you start, the better. Thanks to the power of compound interest, even small amounts saved early on can grow into a substantial sum over time. Don't wait until you're nearing retirement to start thinking about this. Start now. Start today. Planning for the future also means preparing for the unexpected. This could be anything from a sudden job loss to a health crisis. Having an emergency fund and insurance in place can provide a financial safety net when life throws curveballs your way. So, why is planning for the future so important? Well, it's simple. It provides a sense of security and peace of mind. It eliminates the stress of uncertainty. It gives you the freedom to live your life on your terms without financial worry. And above all, it ensures enduring prosperity. A good financial plan for the future is like a roadmap to financial security. It's about knowing where you are now, where you want to go, and how to get there. So, start painting that picture, start building that path. Your future self will thank you. Let's summarize what we've learned today. We've navigated through the 4 cardinal rules of financial literacy. First, we dove into the importance of mastering basic financial concepts. Understanding the fundamentals of budgeting, interest rates, and the time value of money is a critical first step in our financial journey. Next, we delved into the realm of risk management. We learned that assessing risk-reward trade-offs in financial decisions isn't just a smart move, it's a necessity. It's about being prepared for the unexpected and making informed decisions. Our third rule took us into the world of debt control. We emphasized the importance of understanding loan terms, interest rates, and repayment schedules. It's about being in control, not letting debt control you. Finally, we ventured into planning for the future. We discussed the significance of investment and retirement planning. It's about building a secure foundation for your future self. Remember, financial literacy is not a destination but a journey, and these 4 rules are your compass on that journey. That's all for today's lesson on mastering money. But remember, the real learning begins when you apply these 4 cardinal rules of financial literacy to your own life. We've given you the tools, now it's up to you to use them. We want to thank you for your time and attention. Your journey towards financial literacy is important to us, and we hope to be a constant guide along the way. If you found this content valuable, please consider subscribing to our channel. We'll be sharing more insights, tips, and strategies to help you stay financially savvy. Remember, the journey to financial literacy starts with a single step. Take that step today. Don't forget to subscribe and join us on this journey. Until next time, stay financially savvy.